Hello, and welcome to a special episode of The Officials. My name's Will.
And I'm Ed.
And today we'll be discussing through our new quarterly volumes report. This will be released every quarter for the previous quarter, assessing volumes, exchange-traded volumes globally, and providing our view of where volumes will be going in the future. We're going to be diving into the new report to start with. This is the first edition of the series, and we'll be unpacking, the key trends that have been driving volumes throughout the quarter. So, Ed, do you want to take us through what's happened?
Yeah. So Q2 clearly has been a pretty volatile quarter, given the imposition of Trump's wide-ranging reciprocal tariffs on Liberation Day, plus then, of course, the Iran-Israel war in June. And both of these kind of geopolitical exogenous events sparked a massive increase in exchange-traded volumes. We saw both of those months were near all-time highs that were exceeded only by March in 2020 with the COVID spike. And so we thought it was really the time to look into what is being traded, how much of it's being traded, where, which products, and what are the drivers behind that those trends. So we identified a few of the key themes, and Will, would you like to talk us through which of the themes are the key drivers?
So it's kind of been a bit two-folded in some way. So we've, as you rightly pointed out, we've had some pretty exogenous events that have been driving volatility, and that's one channel through which volumes increase. But there's also been a more kind of structural shift in how the markets hedge, speculate, as well as growing liquidity across different regions. So we'll dive into that first. So first things, the volumes in Q2, exchange traded oil derivative volumes hit an all-time high of over 308 billion barrels equivalent, as we have assessed. That beats even the COVID era spike of Q1 2020. Again, these times of market stress, they drive both a need to hedge, but also they drive opportunity to speculate. Often that's driven by volatility.
And yeah, really, it's been the whole year that we've seen an uptick in volumes. So for the first half, we saw an increase in traded volumes of 23% year on year compared to half one in 2024. So there have been three big months, really. It's been January, April, and June that have driven that increase in volumes. But the overall market activity, I think, has picked up as well due to, as you say, there's more, obviously you have these exogenous events like the Iran war and then the Trump tariffs, but you also have the changes in the market dynamics in terms of access, in terms of hedging and speculation, etc.
So for example, take Dubai. On-screen trading in Dubai has really opened up that market to a wide variety of participants, both on the spec side and on the hedging side. And I mean, if you're just looking at the aggregate figure here, we're up 23% year on year. That's pretty huge. And our kind of central thesis here is that uncertainty and stress drives volumes. If you've read the report, just check out figure 1. And that shows traded volumes have surged, especially since the start of the Russia-Ukraine war, but more recently than that, just this past kind of past year and a half, really, we've started to see a strong uptick in volumes. So let's unpack the geopolitical aspect this quarter. April saw Trump's Liberation Day tariffs really shock the market in many ways. The markets were expecting a bad result there. They're expecting pretty hefty tariffs, but I think they exceeded even the market's expectation. And this led to a rapid adjustment to agents' contemporaneous information sets, and market pricing is a function of information set. When that changes, then your expectation for price will change. And this is a risk for producers. This is a risk for refiners. So on the hedging side, we'll see that motivate some more hedging activity, as we did during the Russia-Ukraine war. And typically, those new hedgers, they're not just getting to hedge periodically. Once that's ingrained in their trading practices, they will continue to do so. I mean, if you just look at, we saw we saw in June that escalations between Iran and Israel, with the US launching a strike on Iran, Brent jumped from $60 to briefly over $80 in just a week. The 12-day war really kind of uncertainty rippled through the market, and the key here wasn't just price but volatility and traders pricing the scenarios such as straight to full nose closure. I mean, that wasn't going to happen, was it, Ed?
No, in real terms, it wasn't going to happen. And both for the geopolitical reasons, Iran's own self-interests, plus, of course, the practicalities of closing the strait. But to go back to the tariffs as well, I think this is where they both come together, although they're very different events. Both create an enormous amount of uncertainty. Yeah. On the tariff side, you were suddenly having to remodel all your demand expectations, as the economic hit would have greatly decreased global oil demand and product demand. So that had a massive impact on price to the downside. Conversely, the Israel-Iran war was more of a supply side issue, where traders and refiners were worried about their access to oil in the event of disruption to the strait. So really what was driving this all was the uncertainty element, right? Yes. And uncertainty, for one thing, like you said, encourages you to hedge, because if you're uncertain about your prices in the future, it's very difficult to produce any kind of forecast or expectation for a business point of view. Commercially, it's very difficult. Yeah. And equally, if you're a speculator, you can take your own position thinking that events are going to unfold like this, therefore I want to position myself like this to capitalize. Yeah. So it really encourages both sides of that spectrum.
Yeah, and I mean, if we just have a look at figures 3 and 4 in the report here, this is looking at implied volatility. So this is how traders are pricing future volatility through options. So that we also detail Caldera's geopolitical risk index, and that is a kind of a sentiment measure. So it looks at media news reports and scores each of those reports on how tight is geopolitical risk. And we can see there quite clearly that there's a pretty contemporaneous reaction in implied volatility to a spike in geopolitical risk. But let's unpack that a little bit further, because I mean, one finding in the report is that the relationship is state dependent. And by that, I mean, when volatility is already high, geopolitical shocks push implied volatility even higher. So we have almost like a feedback loop there. And that's definitely what we saw. We had implied volatility already at reasonably high levels because of Trump policy, etc. But then we had a geopolitical impulse that was provided by the escalated tensions in the Middle East. And we saw implied volatility rip in option pricing. So to look into that, we estimated a quantile regression, which looks at the varying response in implied volatility to a geopolitical shock for each percentile of the volatility distribution. And we can see that at those higher volatility levels, the shock is more pronounced. We have a stronger reaction, and that can be seen in figure 5. We also then looked at the converse, so looking at, okay, so what about for each percentile of the geopolitical risk distribution? And we can see that only at the top quantile do we actually have a strong, notable effect on implied volatility. So that just tells you that it's only really when we're getting to those extremes that we see any sort of pass through into implied volatility. And then if we look at the SVAR, which is on if we look at figure 6, we can see that we estimate an impulse response function, which here we're looking at, okay, if we have a implied volatility shock, what does that mean for volumes? And we can see that there's a pretty strong contemporaneous increase in volumes traded for an implied volatility shock. So that really translates. We can see that here volatility is driving volumes, and more so than that, implied volatility is as well. So that brings us on to our next section, which is the hedging interest.
Yeah, so I suppose the first question, when you've said that this implied volatility is driving a great increase in volumes, is by who and why? And one of the main constituents of that increased volatility comes from hedging, because if you've got high volatility, high uncertainty, you as a commercial entity involved in the market has more motivation, more appetite to hedge in order to protect yourself from that volatility, from those sudden unexpected price moves. So, for example, in June of Q2, we saw a lot of hedging by US shale producers because they had been hit quite hard by the decreased crude oil prices that we'd seen following Trump's tariffs, and also the increasing costs raising their break-evens. So they were really taking advantage of the higher flat price environment to hedge and lock in their margins for the future.
You know, we had shale producers typically have quite tight margins. Steel, for example, is a big input cost for them, and that was hit with 25% tariffs quite early on. So, you know, when we did see that aggressive rally in flat price, those producers are just going to come out and hedge as much as they can, and that's exactly what happened. But we also saw on the product side, so distillates were really quite tight. We had a refinery outage in Israel, and just the broader geopolitical escalation there, combined with stocks being really quite low. I mean, US distillate stocks were 21% below their 5-year average. This led to a really quite tight middle distillate market. And our refining margin rose from about $5.85 in Q1 to $7.33 in Q2. So we're going to see a lot of refiners come in and start hedging that there. So check out figure 7 for the refinery margins.
And then I suppose the other side of the coin is really the speculative side, right? Because you've got the hedging, which is more of an operational and risk management tool. And then you have speculation, which is obviously seeking to make the most of price action in order to make a profit. Now, hedge funds are one of the key players here for obvious reasons. They're always looking into the market as a means of like diversifying and also making a profit on their investment. And at the start of Q2, the net long positions in Brent futures were near the year's highs. So that meant that everybody was obviously kind of positioned for a price to rise. However, you had kind of the opposite, because the tariffs destroyed expectations for demand, and therefore Brent sank as low as $60, even briefly below into the 50s. And really, then you get to June, and you have kind of the opposite effect, where you have prices spike on the Israel-Iran war when we go back up to the 80s. So you then have an incentive for the hedge funds to get back involved again, because volatility's back. They can look to profit on that. And net long positions hit 325,000 lots. So that's a massive net long position. Plus, if you look into the option market, the open interest in call options with the $90 strike for, I believe, September it was. It was. Their open interest surged, and you also saw a 280% jump in the premium for that option. So clearly there is plenty of scope for these hedge funds, these speculative players, to make a profit, and that will naturally incentivize more activity from these players. Yeah, definitely. But then, you know, by the end of the war, we saw those same premiums collapse by 98%, leaving some funds, you know, they got wiped out. Really, we saw some pretty big double-digit losses. But again, you know, this is all part of the what volatility generates. You know, it gives, it motivates the entry and exit from trades at a higher frequency. Which then naturally translates into higher volumes. Exactly. So, I mean, one particular case study that we looked at this report has been the Murban case study, specifically Murban Futures on IFAD. They were launched in 2021, and since we've seen Murban volumes explode. Over 2.1 billion barrels traded in the second quarter of 2025, and that's a 7-fold increase from launch.
But it's not been completely smooth sailing, has it?
Yeah, well, April, for example, while the rest of the market was booming, the volumes traded in Murban Futures were actually down by 45%. And it proves that there isn't necessarily an entirely correlated relationship between an individual contract's volumes and global volumes being traded. So Murban is kind of a specific case, obviously, because its production, its export is controlled intensely by ADNOC.
Yeah.
So it has its own characteristics. And we saw recently some kind of policy decisions by ADNOC affecting the confidence in the futures as an instrument because of changes to loading schedules, export plans, and all these kind of logistical and supply and demand features. So the bottom line is that effectively, although you've got these additional contracts coming in, 2.1 billion barrels out of what is nearly 1 trillion barrels is still a very small proportion. And in fact, the share of Murban Futures in the global exchange traded volumes picture has decreased from when it was initially introduced in 2021 to today. So although they've increased sevenfold, the share that they have within that global context has decreased because of the overall market's increase.
Yeah, definitely. I mean, it's definitely an interesting one to follow, especially in the context of ADNOC and the loading discrepancies that emerged this quarter, and also how that factors in with the Dubai pricing mechanism. So we've got some videos on that, so go and check those out as well if you want more information there. But that kind of moves us on to our forecast. So where are we heading in our view?
Well, if we just look at the numbers, the baseline forecast that we've produced shows a 13.7% increase in traded volumes in 2026 to hit 1.18 trillion barrels. And then we expect it to accelerate again to 2027 to hit 1.43 trillion barrels, which would be a 33% jump from this year in our forecast.
And that's for a multitude of different reasons. I mean, one is looking ahead. I think it's reasonable to expect that we haven't seen the end of the exogenous volatility drivers. Trump, for example, remaining in office will prove to continue to provide shocks to the market. We also take the view that we aren't behind geopolitical risks. They seem to have moderated a little bit in the Middle East for now, but I don't think it will be the last we see of escalation there. Yeah. But then on top of that, there's core macro drivers as well. So we're embarking on an easing cycle in the US, which should stimulate growth there. At the same time, we have seen a resurgence in aggregate output from China. China are buying a lot of crude, and that's going to be a driver of hedging interest and a driver of demand there. So you have kind of an organic growth in oil demand, which will drive further hedging exposure, but the hedging interest. Sorry.
And when it comes to open interest, we are also expecting an increase there, partly as a function of that hedging demand. Yeah. So next year in 2026, we're expecting a 7.2% increase in open interest, and then 6.7% increase again in 2027. So there's still kind of growth to come in that liquidity aspect of the market. You can see in Figure 9, we lay out the chart for that forecast.
Yeah, and one key metric here is on the speculative side. So we take the view that the yield curve in the US is going to steepen further, which should support liquidity, and that will support speculation. We've seen hedge funds become more and more integrated in the oil complex. They provide a big source of liquidity, and that will only continue to drive volumes higher in our view. And so, we take the view that 7.2% in 2026 for open interest, 6.7% in 2027, 13.7% in 2026 for volumes, and volumes will reach 1.4 trillion.
in 2027. Yeah. And if you want to have a breakdown of all the figures in the forecast and the assessment, go to pages 17 and 18 where we lay out the data in a quarterly and monthly table. So it's all very accessible there. But I suppose that's really what we wanted to cover today. So just to kind of wrap up, what in Q2, why have we chosen to do this report and what are the key drivers?
Yeah, I mean, Q2 was a record quarter. Driven by geopolitics, hedging, speculation, and the structural story is pretty clear. I mean, volumes are only on a strong upward trajectory. And, you know, we'll now be looking ahead, watching tariffs closely, Middle East tensions, China's growth story as well. And, you know, we'll be back in Q3 with another review and we'll update you then.
The forecast, yeah. So, if you want to find the report itself, you can follow the link in the description or go to flux.live to the officials page where we have this report and all of our daily reports. Equally, follow us on LinkedIn or Twitter where you can keep up to date with all the stuff we're publishing. And so for now, thank you very much for watching and we hope you find this report useful and make sure to tune into the next episode of The Officials.
Thank you for watching.